All right. Hi, everybody. Thank you for tuning in to today's panel discussion and session. Uh, Before we kickstart, unfortunately, one of our panelists, Khalid, representing Nua Capital, was a last-minute dropout due to a personal matter that he had to take care of quite urgently. We wish Khalid the best and look forward to having him in the next panel. But we have two more awesome panelists joining me for this conversation. We have Sonal Premjee and William Baubeen. I was going to do a quick intro for all the panelists, but since we have one less panelist, I think I'm going to ask my panelists to introduce themselves so they can really speak to their experience, their backgrounds, and why they're a great fit for today's topic. Sonal, so if you could kick us off with an introduction about yourself, who you are, what you do, what your background is, what you're excited about. Then let's hear from William, and then we can kickstart and get into our questions.
Sure, thank you. Hi everyone, I'm Sonal Premjee. I'm investment manager at British International Investment, which is the UK DFI. I'm part of the venture capital team, out of which we make our sort of fund and some of our direct investments into early stage companies. In terms of fit for the panel, we invest in both Africa and South Asia, and those are basically the only markets that we invest in. So the topic is quite closely related to what I do on a day-to-day basis. Over to you, William.
Awesome. Yeah, thank you so much. So William Baubeen, Managing General Partner of Orbit Startups. We are a VC fund. We started within this fund, the first accelerator program in an emerging market in Asia that's still running in the world. And please, if you find another one, let me know, because I tried to Google it and use ChatGPT and Perplexity and a bunch of others, and we can't find another. So since 2010, we've been investing in founders to help them leverage tech to drive economic transformation. First in China, since 2018, no longer in China. So we're South Asia, Asia, and we're also Africa. And we have a few investments in LATAM. So again, how do you leverage tech to drive economic transformation across markets, especially emerging markets? And we're working with now 240 startups and their founders to go from 0 to 1, 1 to 10, and then hopefully 10 to 100 and beyond. Thank you.
Awesome. Thank you very much. Quick intro about myself. My name's Ali Samir Oosman. I'm the ex-founding MD for Endeavor Pakistan, and more recently, I lead investments and venture building at Disrupt.com, one of the leading venture builders out of the MENA region, building global tech products to scale. So just kicking things off, to set the tone for our conversation around the investment landscape and similarities and cross learnings across Africa and South Asia. Sonal, if you could just kick off kind of a broad landscaping question, which is, we've seen the VC investment landscape grow over the last 10 years, both in Africa, South Asia, and of course in the MENA region. But have we seen the level of maturity that we think is required for investors to have a sustained approach to capital investments across Africa and Southeast Asia?
Yeah, sure. Happy to kind of take that one. And William, feel free to come in. I think, from my perspective, like obviously we've seen some decent growth. We've seen some good startups that have been funded, and we have seen some decent returns. But I will say, but obviously, these ecosystems are still quite nascent, especially compared to the more sort of developed market ecosystems. And so I think sustained capital growth sustained capital into these markets has been difficult, just given the global environment over the last few years. I will say, I think the one thing that we do see that's kind of good in these markets is that there's a lot of entrepreneurial activity. And I think what's kind of shifted over the last 10 years is that being a founder is not as uncommon anymore. And so around this, there have been good ecosystems that have grown as well. So like you're talking about sort of accelerators, incubators, co-working, sort of angel investors, these things have also ramped up. And so I think hopefully as these ecosystems mature, there will be more capital coming into these markets. I will say one thing that is probably still required for more capital will obviously be to see more exit outcomes. And so, India obviously is different to the rest of South Asia, but we have seen, pretty good exit outcomes in India. Africa is starting to see a few. And I'm sure Pakistan, is kind of, not far behind. But I think in order to see sustained capital growth, we're going to need to see better exit outcomes.
Got it. And William, could you just touch upon that a little bit? I mean, obviously, leveraging your experience from Southeast Asia and just touching upon a part of Sonal's answer, uh, a sustained growth in the form of capital availability and deployment in the region does require a certain level of sophistication of financial markets and, of course, maturity in those markets. What have you seen, I guess, from Southeast Asia and now with your time spent in the Middle East, uh, the transformation that's taking place? Do you feel that there's an opportunity now to see that sustained growth? And are there any kind of policies, regulatory efforts, kind of government mandated strategies that you're seeing that will help enable that and make it much more of a lasting opportunity for capital to come to?
Yeah, so I would tell a story, and some of the Paklaunch folks have heard it before, but like when we started investing in, say, China, it's an emerging market in 2002, 2003. The total amount of consumer spend in the country was about 600 billion. And at the time, tech was early. The total market cap of all the tech companies was 1.5, maybe 2 billion. And what happened was tech unleashed a economic transformation. I mean, government had a role, but tech really unlocked things. When I stopped investing in China in 2018, the consumer spend had gone from 600 billion a year to like 5.5 trillion a year. But the key thing is that the returns were there. So the total market cap of the space went from a 1.5, 2 billion total to 3.5 trillion. And so there's, on the one side, an economic opportunity driven by tech, but there's also the ability to drive real massive returns based on tech. So started investing in India 0506. And so when we started investing in India, we're like, there's no returns in India. There's no returns in Southeast Asia. What happens is when you build real businesses that have positive unit economics, they start making money, and the capital will follow. So for Pakistan, we're the most active international investor in Pakistan. And we started kind of early, 2019. But our companies are driving real economic value, positive unit economics. So when, the last Paklaunch unconference that I went to, which was in Silicon Valley, the news came out that the total VC money that was deployed in the country in Q2 was actually zero. It doesn't really actually matter that much. Why? Because you have companies really creating value. They have positive unit economics. They're profitable and they're growing. So I would say that it's just a matter of time. Now, of course, government plays a role. Our general idea is if the government stays out, that's actually a good thing, but the government plays a role. But as entrepreneurs, and for myself as a VC, we are looking at not just copy paste, but taking a lot of those learnings and driving a similar pattern in other markets. And so that's why we're heavily invested in South Asia and we're heavily invested in Africa.
Awesome. That's great context for my next question, which is kind of double clicking on similarities between Africa and South Asia. And Sonal, I'll start again with you on this one. From your experience in portfolio management, having deployed capital, and then, of course, in some cases, orchestrating or manufacturing or supporting exits, right? What are those differences? So maybe one or two differences and one or two similarities between Africa and South Asia. And for the purposes of this session, what I would say is when we refer to South Asia, let's exclude India because India is an anomaly, right? It's got the third largest number of billionaires in the world. It's got financial markets participation just in terms of access to capital and market caps that are like transformative for the industry at large, right? So I think that would be an unfair comparison compared to the rest of South Asia. So if you look at it as South Asia minus India compared to Africa, what are those differences and similarities from your perspective?
Yeah, of course. I mean, look, I'll stay away from sort of the typical EM similarities, obviously around macro, currency, political landscape, etc. I would say something that has struck me over the last few years has really been kind of the good founder quality in terms of similarities, and the strong sense of, entrepreneurial zeal or sort of hustle, if you will. We're really seeing a sort of good set of founders come to market. This used to be dominated by, what you call repatriates. So I guess people who'd studied or worked abroad and then come back to their countries to build something. But we're now seeing, obviously good repat founders, but alongside more local founders who've studied and worked locally, who are familiar with these markets, who know what the problems are and are building to solve them. And so I think, that's a good thing that we're seeing across both Africa and, South Asia. From a differences perspective, I would say a key difference is probably how companies have to think about scaling. So obviously Africa is made up of 54 countries, each with their own regulations and currencies, etc. And so with the exception of, the very populous countries like Nigeria and Egypt, founders do have to think about scaling outside of their core markets quite quickly into their journey, and this is often quite difficult. With Pakistan and Bangladesh being as populous and vast as they are, there's more room for sort of organic growth and scale, without having to think about geographical expansion, right off the bat. But obviously, with that said, once you saturate the key hubs, I do think digitization also becomes more scarce. So, to Pakistan's advantage, they also have pretty good links with the Middle East, where purchasing power is often stronger, and that's also a good growth story. I'll pause there, but yeah, happy to kind of elaborate on any of those.
Yeah, I mean, before I go to William, it would be good if you could just double click on the investment side of things. So uh, uh, I think we can all agree, emerging market grit is a function of a broken system, and broken systems make you stronger entrepreneurs because you're solving day-to-day challenges even in your personal lives. Uh, but what about the investment differences from that landscape, right? Considering things like devaluation that impact
Yeah.
future follow-on rounds, such as portfolio companies that are showing year-on-year growth in local currency, but in a dollarized fund mandate are down on their investments, and therefore is a tough conversation with LPs. In the view that any exits in local market IPOs would not yield the returns at which the valuations are being funded at, and so on and so forth. So if you could just maybe touch upon just that
Yeah.
aspect as well.
Look, I think on the FX side and devaluations, etc., like it's a fact of of life in these markets. But I also think, like if you're looking at global asset allocators, they don't necessarily want to make domestic returns. And so ultimately the businesses that we are seeing in our portfolio that are performing well and are still continuing to attract funding are those that have managed to either secure dollar revenue streams or those that have been quick to kind of pivot into sort of more stable revenue streams, or those with, who've managed to keep up with kind of inflation or even kind of double revenues by opening up new revenue streams, etc. So I don't think there's two ways around it. I mean, I think, if, as a DFI, we obviously have a mandate to invest in a lot of emerging markets, and so we'll continue to do so despite devaluations, etc. But I do think that if you're building a business, you have to build with the mindset that you want to ultimately attract commercial capital as well. And the idea there is that you then have to make sure that your growth can outpace those things.
Awesome. Great context to get to William answering this part of the question, which is, same to you, William. Differences and similarities from what you've seen. And I understand most of that exposure and over the last few years has been Southeast Asia focused, but you do have considerable amount of exposure in South Asia, and I've seen kind of companies kind of taking that expansionary route westwards, right? So just speaking from a private capital or a commercial capital approach, what are the similarities and differences you're seeing? But if you could also touch upon what Sonal mentioned, right? As DFIs have a mandate, they'll continue to invest because economic growth and uplifting of economies is a big part of the mandate. But as a commercial investor, how much does liquidity creation and obviously performance for LPs play a role in your decision making when it comes to coming back to invest and take a bet on these markets?
So I would say, not to be too controversial here, but you got like 20 years of scar tissue in China, one of the most competitive markets in the world. and especially being like international investors in China, it was difficult. But I worked on the Alibaba IPO, helped them go public 05, 06, and working with Jack Ma, the idea is that his first model for the first IPO was basically digitizing manufacturers, digitizing small medium enterprises, and helping them sell online so that they could make more money. So we're taking that same type of ethic and that same type of approach to with local founders, digitizing markets both in South Asia and Africa. So it's not a copy paste from China or India to the rest of the world. What it is we do this learn and localize model where we try very, very hard not to tell the founders that we work with what to do. But what we're really trying to do is help them design experiments, implement lean startup. You can read the book, but what happens is if you have advisors and mentors around you that can help you give that book some context and design the experiments, help the founders that we work with interpret the results. What you can get is I'll give a couple of examples. What you can get is extremely powerful. So, Alibaba digitized micro SMEs in China and they opened things up. Paklaunch, so a Pakistan example, we invested in a company, multiple companies that digitize micro SMEs and small businesses, mom and pop shops, kirana stores in Pakistan. In the last 4 years, the companies that we've backed have digitized over 1.2 million businesses in the country. I think they're seeing, devaluation post money in US dollars, like $7 to $8 billion in monthly transaction flow flowing. Now, are you going to try and charge those businesses for software? No, you need to take an emerging markets approach to the problem, but also an emerging markets approach to the monetization. And a lot of that comes in like trade credit or like factoring, or credit's a bad word, but basically helping open up commerce, bringing that transparency enables things to really open up. And what we're doing across both Africa as well as South Asia is cutting out the middle people, digitizing farmers, the supply chain, through to the companies that are, the small companies that are selling the food, making sure that there's less food rotting between the field and the retail. And it's really driving a change. So, I'll give one last example. We invested in a company called Dastigir. And we were their first VC, pre-seed seed level. They're making a little bit of money. We invested and we helped them scale up. Now they're digitizing many of the companies in small medium businesses in Pakistan. So it's a marketplace between people who produce and people who sell. And then we help them expand, not just internally within the country, but also cross border. Helping people who produce in Pakistan sell to the Middle East, sell to the UK, sell to Europe. And so what happens here is that when you have a real focus on positive unit economics and you're a profitable company like Dastigir is, yeah, sometimes you have to make some cuts. Sometimes you have to lay off like 70 engineers, and that's like very painful in the market. But what really matters is the fact that they're a profitable company that's scaling and growing, and really putting Pakistan on the map, not just in Pakistan, where they're still operating, very much so, but also across the region and now across the world. So I think that the key point to take away is that for early stage investors like us, we've done 25 investments in Pakistan. One left the market because they were seeing huge competition from their home market in the Middle East, but the other 24 is still alive. And they're not surviving on our $180,000 check, and especially in this fundraising market. So the idea is to really try and understand the local problem, bring a local solution, and then take it to positive unit economics. And for us, you nail it first, then you think about scaling it. So if you have this model, you don't really rely upon capital that much. And this is the same market that we're applying to Pakistan, to Bangladesh, as well as to Africa, where we have almost 30 investments.
So, William, back to you again, but just kind of.
Yeah, give Sonal a break. She's been going first the entire time.
No, I know, I'm just switching it up. But you ended on a good note, right? And it's relevant to the next question, which is, we're in end of 2024, entering 2025. All
Yeah.
of us within the VC, venture build, technology, startup space already see the narrative around us changing over the last 5, 6 months, right? There's been, I mean, the founders are all building AI and the investors are all looking for AI. And all of a sudden, nothing else is talked about. There was a time where all we would hear is fintech, and now there's a time where all we hear is AI. So, kind of in the post-COVID era, we've seen capital deployment strategies, broadly change over the last 2 years, right? There was a time where you had exciting, fast growth, negative unit economic models that were being funded all over the place,
Yeah.
but are not being funded anymore. And there's a lag effect of founders in emerging markets having seen that, and now, in some cases, still building for that. But the region holistically, even when it comes to specific markets, hasn't really digitized enough across the board,
Yeah.
both vertically as well as horizontally, right? And it's not culturally mature enough for B2B software companies to truly scale in their markets or their localized regions. So, what do you think is being funded in the region, i.e., Africa and South Asia today? And where does that opportunity lie moving forward? Because even if you're building for AI, it's tough to imagine an AI vertical SaaS solution being adopted by industry at large today, right? Just because of the maturity of those markets. So that by default will target, I don't know, the US or Southeast Asia. So when it comes to looking
Yeah.
at it from an investment point of view, where does that opportunity lie as an investor?
Yeah. So, again, this is going to be like a little tough love here, but like, most of the original Indian businesses are body shops based on software. There's a lot of money flowing into Pakistan, body shops based on software, but it's all flowing into small pockets, right? Well, they're very bulging pockets of people who make lots of money selling software to the West. For us, we're Pakistan for Pakistan, we're Africa for Africa, we're Bangladesh for Bangladesh. And the funny thing about AI is it makes those body shops irrelevant. Those businesses will all die. If they don't know, it's like the frog in the pot, and the water's heat's gone up, they're already dead. They just don't know it. Okay. So they'll be replaced. And that's going to unleash a huge amount of talent into the ecosystem. So for us, what we're looking at, and there's a lot of US based prognosticators, early stage VCs, and they're saying, we need to go back to real businesses and real industry where we're taking technology and actually driving into making proper businesses that actually touch humans, that deliver product. If you look at these, what's your thoughts for 2025? Well, it's what we've been investing in for a long time, which is how do you apply tech to drive efficiency and productivity and lack of waste in very fundamental, very traditional industries. We call it boring shit that makes money. But we think that's where the huge opportunity is. And the fact that a lot of those body shops will die because they're no longer relevant because of AI brings up a huge opportunity, especially in emerging markets around the world. By the end of this decade, emerging markets on a GDP basis will be the majority of all production in the world. Okay. And so developed markets grow like this, emerging markets grow like this, and emerging markets excluding China grow like this. The key for us as capital allocators or for DFIs or LPs who give the VCs like us the money is how do you actually capture that? How do you make sure it's not waste? And the way you do that is by bringing tech and digitizing these like very traditional industries. So we have over 30 portfolio companies, South Asia, Africa, that digitize micro SME mom and pop shops. And they're enabling these businesses to fix their supply chain, make more money. Like digitizing restaurants in India where they walk to the market, they buy their spices in the local market, they buy their inputs in the local market, they walk back to their mom and pop little restaurant and they sell. They're basically their cost basis is retail, and they're just adding labor and selling small, like 10% profit margin. But on average, if you fix the supply chain, we're seeing their profit margin, their net income for a restaurant go from 10% to 18%. That's an 80% jump. Okay, once you do that, where is the next opportunity? Can you enable these people who have trust in the communities to then distribute healthcare, transportation? We have back Buskaro in Pakistan, enabling men and women to commute to work in a safe and efficient and measurable way. How can you bring other services in? And so we are not trying to transform the economy by wiping out Main Street or by wiping out the people who really drive value in that economy and have the trust. What we want to wipe out is Google and leverage the trust of the people in the market and then empower them and enable them to be those small business owners that then can drive education and transport and health and even commerce into their communities. So for us, we're top 5 to 10% performing VC in the world, DPI, TVPI. What that means is like we put $1 in, we've already returned $2.23 back to our investors in our 2015 vintage. So people give us money, we give them money back. And on paper, we're doing amazingly well, like after fees, like 5.5x. The returns will take care of themselves. The key thing is like we can't just be investing and backing founders that are doing the same things, copy paste from YC, and expecting a different result. We need to do things that borrow from what's worked in other countries, like China, like India. And it's not China today. It's China 10, 15 years ago when I started there. It's not India of today. It's India of like 5 or 8 or 12 years ago. So for me, it's a little bit of a I don't know, I call it maybe religious is the wrong or bad word, but it's something I really truly believe in, that if you empower folks in these markets with technology, you break down the barriers, you can really have an outsized impact. We're not an impact fund, but we're a fund that really tries to have impact.
Awesome. And Sonal, is there anything you can add to that from your perspective?
Yeah, sure. I mean, look, I think, Ali, like the answer to your question it was a little bit in your question as well. I mean, I think you said like people are funding fast growth, negative unit economic models. And I think that's probably the part of the issue. I do think the founders that have remained today, and the ones that are still building are obviously building, as William kind of said, far more domestic focused solutions. These are, more bootstrap founders. They're more resilient and they're optimizing profitability and unit economics from the get-go. And I think that in itself is the answer. But I think taking a step back, if you do have to look at, more sector specific stuff, the things that we are seeing being funded in this market in any case, I mean, it doesn't necessarily have to be B2B SaaS in order to succeed. I think, B2B is a good starting place. So obviously, these businesses generally do get more funded more in this environment in any case, just because the people that you're selling to, inherently have more predictability, and they are a little bit more sophisticated. So from like a sector perspective, obviously we're still seeing fintech is relatively well funded. Payments, SME lending, group lending, some SaaS solutions that are actually building for existing lenders. And trying to sort of help them improve efficiencies and like how to underwrite debt as well as how to monitor it. I think other B2B businesses, like sort of in supply chain or marketplaces, where you're making the process more efficient, you're delivering value to the end customer in terms of affordability, these are still getting funded. And then also more recently, obviously, climate, which is also the buzzword like AI. We're seeing quite a bit in ag, as well as kind of the EV ecosystem, which is also getting funded.
Thank you. Yes, I think we're seeing a lot of that. So that's really good context. Maybe a little bit controversial, but it'd be good to know, right? Because this is an investor-focused panel, and controversy is sometimes just more interesting. But from both of your experiences, right? Having deployed in emerging markets, having invested in Africa, invested in Southeast Asia, what would you say is, and let's just say what is the one mistake that you feel you have made that you have learned from and will not make that mistake again when it comes to entering a new emerging market in the region, or something that's totally scarred you off a vertical in a specific market? And to give you context to help maybe answer that question, from a Pakistan perspective, over the last 5-6 years, there's been a lot of capital that's been invested into agri-tech, for example. different ventures solving for different parts of the value chain. Holistically, a lot of VCs that I've spoken to have been scarred off that to invest again from that sector, only because the holistic learning has been that the value chain is so broken that one solution cannot solve for the problems of agri-tech across the value chain, right? And that's been a learning. So many of them are scarred away from that, from a Pakistan context today. So keeping that example in view, for both of you, what's that one kind of mistake or learning that's helped you with regards to your future deployment strategy?
You want me to hit this first, or
Yeah, sure.
Okay, so I think the most important thing is that you need to work with a VC or an investor who understands that they don't know very much. Because experience can be interesting on the one side, but it can also be like a bad disease, right? So the challenge, as we all know with experience, is like, oh, I fell down and I'm not going to like walk in that way so I don't get hurt again. But the challenge is that if you shy away from it, but then technology changes or the market changes or the founder, like things change, then you never go back again. So the thing that we try and do is try and put our like ego in our back pocket, right? Yeah, I've been doing tech investment 28 years. I forgot about this fact, but like I taught Michael Dell how to use his BlackBerry, and most people alive today don't even know what a BlackBerry is. He's like, "Oh, my thumb hurts," and I'm like, "Yeah, if you hit the scroll bar, it'll auto like reverse down, so you don't have to use a scroll bar." And that was like 1997, 98. So the general idea is that don't give up on an idea of solving a problem. You just keep on trying to do it. So I'll give you a thing. We're not like super crypto heads, but like in 2015, I invested in two companies. And there was this new thing called Bitcoin, and Bitcoin was 230. And I invested in two companies that were leveraging Bitcoin to send money, one from Africa to China, one from Middle East to China. And the idea was that there was this problem where if you wanted to send $5,000 from Africa to China, so you can buy smartphones or blue jeans or whatever, it would take over 2 weeks and would charge you $500 to send it. So that just new technology, right? Okay, can we like leverage it to send it for less? And we invested in a company. It worked out really well until China outlawed Bitcoin. Okay, but we did not give up. The key thing is that the world changes. So just because something did not work before does not mean it won't work again. So you have to keep an open mind and keep on experimenting. So a year and a half ago, we invested in a company called ScaleX. And what do? They help people use crypto to send money from Nigeria to China and to other places. And the Nigerian government is super anti-crypto. They're like, no crypto because it's sucking money and allowing people to send money out of the country. But the company we backed is a simple peer-to-peer exchange with an escrow. So somebody with Naira wants stablecoin. Somebody with stablecoin wants Naira, and they just exchange. So there's no capital flight. And so what you have is all these gig workers and people working online in Nigeria can actually take their stablecoin and turn it into Naira so they can buy food and shelter and lodging, right? The basics. And all these SaaS companies and trading companies that have Naira that want to buy things from outside can exchange them. And there's no capital flight. And the government started to tell the banks, stop shutting people's accounts down because this is driving our economy. So just because something didn't work in 2015 doesn't mean it didn't stop working in 2023 and 2024. And this is driving a lack of drag. And the problem with emerging markets is there's like drag. There's a cost to doing everything. In like Pakistan, for example, there's a cost to get regulatory. There's such a high cost to getting regulatory approvals. It's almost impossible, right? And so if we can leverage tech to reduce drag, we can drive a real economic transformation, and that's what we're about. So that's the preachy side. Sorry.
That's fine. Sonal, any one learning from you? Something that's
Yeah,
just
look,
been
there's many that come to mind, and I think probably incorporating FX devaluations is one of them. But I think maybe, if I want to maybe go into a more sort of granular example, I'll say like, on the B2B supply chain side, these companies, are really relevant in the markets that we invest in because of the prevalence of, I guess, mom and pop stores. But I think, what you've seen, especially in Africa, is a wave of consolidation across these businesses. And it's just really because sometimes just building innovation, specifically geared towards very small customers it's quite difficult to get them to pay for these things on a recurring basis. And so I think, there's a need for these businesses, and so people should continue building them. But I do think having, a strong view around kind of where you're going to capture value. So whether that's, maybe having a fintech angle or having, something that's more geared towards the FMCG producers or manufacturers as well, so that you can sort of increase the stability of your revenues and capture more sort of wallet share across the market is important.
Thank you. I think that was
Yeah, I can double tap on that if you want. I mean, I can give you some brutal examples. So we have, I don't know, I lost count, but over 30 companies that digitize micro SME mom and pop shops around the world. Okay, and it's not a copy paste. It's a little bit different. It's not like we're taking Alibaba and trying to glom it onto the rest of the world. So I'll give you the tough case. So we invested in a company called Africa and it failed. Called Market Force in Africa and it failed. So we invested, and this is like a year and a half after YC. We invested. We were like flat to nowhere. We helped them change their model in Kenya a bit, and then so basically we helped them. I don't know, it's like 10x their net revenue in 12 months and go profitable. Okay. So then they raised a whole bunch of capital, 8 million of which never showed up, which is very difficult. 8 million out of 20 million, if it doesn't show up after they sign docs, that's a bad thing. So don't spend money until it's in your bank account. But the key thing that also killed them is that they went from Kenya into like 4 other countries almost at the same time. This whole hyperscale model that Reid Hoffman came up with, I think the time for hyperscaling in an emerging market is basically pretty much always never, right? So you got to go, you can't eat the entire elephant all at the same time. You need to go like step by step by step. Whenever you're going from one market in an emerging market to another market in an emerging market, it's like product market fit every time you go. And so the lesson for this one is don't spend the money until it's in your bank account. But the real one is that don't listen to your VCs when they said you have to expand so much. Take it step by step. Find product market fit before you go into the next one. So I'll give you a positive example. Okay, that was a negative one. And they're good guys, and they did well until they didn't, and it wasn't actually all their fault. So I'll take the hit on that one. But we have another company. There's a company in China. It's like I don't know, 20, 50, $40 billion company called Pinduoduo, PDD.com, and they enable farmers to sell their produce online to consumers. Okay, so you can't actually just copy paste that to Africa because individual delivery into a consumer in Africa just doesn't make any sense. So you have to localize it a little bit. We invested in a company called Price Pally, and they enable local agents and local mom and pop shops and local housewives and like anybody in the neighborhood, like dudes with a smartphone, to take orders and collect the money. And then they order from the system and it cuts out all the middlemen. So usually what happens with food, as you might or may not know, is it goes from farm to wholesaler to distributor to market, and it finally gets to the shop and half the food rotted, or maybe a third of the food rotted. So if you can cut out some of those people and just like clean it up a bit, what you can do is you can bring wholesale pricing or close to wholesale pricing into the community and give this local business person like a cut. So they collect the money, they order the food, and a truck shows up and it dumps a pile in front of them, and they do the last 500 meters distribution. And on average, the food cost in Nigeria goes down by 20%. There's a small business owner created by it. The farmer makes more money and there's like less rot, and we're cutting out the local gangsters that are like the middle people that are like clogging up the system. So they're basically the same model, pretty much in the same countries. And one of the challenges, you need to manage your investor, you need to understand like why capital is not always such a great thing. And you need to have advisors that can help you like push back. Like maybe I don't want to go into 4 countries at the same time. So there's a balance. And so there's venture and there's capital. And then there's the founder, and there needs to be a bit of a balance between crazy venture capital that requires reporting and corporate governance, like proper measures, but then the founder who's really driving things. And then we invest in co-founders. So hope that helps.
Yes, it does. And we actually have a lot of questions coming in that I was reading, but I have one more. So I'm going to ask mine, and then we're going to pick some of the interesting questions that have come through. My last question is, and just kind of coming full circle from allocation to deployment to portfolio to learnings now to exits, right? And the last question from my point of view is, we know exits in the region are challenging. We've seen that. We've all seen that in our own ways, right? And we've seen some returns. We've lost lots of potential opportunities, so on and so forth. But from both of your opinions, as the last comment to my questions, what do you feel can be done in Africa and Southeast Asia, barring India, more from a government and ecosystem perspective and point of view to enable exits, right? William, you and I met earlier this morning, nothing to do with this panel, but we kind of touched upon just what's happening here in the region in MENA, right? About how if we look at Saudi, for example, there's a government mandate, and sure, it's a unique market which has access to a lot of capital, but there's a clear vision in that capital being deployed by the government to incentivize local investors and local corporates to participate in their local public market, to invest in local funds and local entrepreneurs, and then get incentives and advantages if they participate in IPOs on public markets to kind of drive that local ecosystem towards help early stage founders, fund early stage founders, create exits for those founders and benefit yourselves, right? It's a very strategic approach to and some people say it's a bubble, but it's really not, because there's enough capital there and it's being incentivized to be deployed appropriately, right? So when you look at Africa and South Asia, sure, it doesn't have the kind of funding, say, the UAE or Saudi does, but they're large markets in their own rights. And there's a lot of incentives and initiatives that the governments can take in order to create an enabling environment to drive exits. So if 1 point each from either of you or both of you, what do you think, in your opinion, governments in these markets or corporates or large high net worth individuals in these markets can do to help enable that just a little bit more, so it takes us that 1 or 2 steps forward towards having a more sustained ecosystem that enables exit opportunities for both investors as well as founders?
Yeah, I can have a go first. And I think probably not answering your question directly, but I try not to control government. So I don't I don't know what they're gonna do. But I think the important part for local founders at least, and for investors is probably just to try and normalize smaller exits as well. I think as long as there's value created for entrepreneurs as well as investors, it's a good outcome. So $1 billion outcomes and IPOs, I mean, they shouldn't always be first prize. Like, it's something to aspire to, sure. But I think that a lot of these domestic capital markets are not ready for this. And to be fair to a lot of the governments that we're talking about, this kind of the VC market is not their priority right now. Maybe it should be, but it's probably not amongst all other stuff that they have going on. I'll say, like, even on the IPO side, like even India, who lots of markets aspire to, like the IPO market, especially for sort of venture-backed companies, is only really gaining traction now, which is like more than 10 years into having a vibrant VC ecosystem. So I think, corporate acquisitions, such as, Stripe's acquisition of Paystack is a great example in Africa, Network International acquisition of DPO, like these are really good outcomes and not $1 billion in company value or exit value. I think Pakistani startups, also have pretty good ties to the Middle East. And so exiting to corporates there and building something of value that would make sense for those markets also is a good exit path.
Yeah, so I think that drawing on my experience with multiple early markets. So I was in 2000 in Silicon Valley, right? And back then you had pre-revenue or barely revenue companies going public, and they were doing like, $20-30 million IPOs at 120-30 million dollar valuations. And so can we take that learning to other markets? Well, you have companies in Southeast Asia that are doing $2-3 million in quarterly net income. And they've got not huge market caps, but 150-180 million dollar market caps. And the difference between like all these markets is a little bit about like PR, but what I would call it is actually education. So when I worked on the Alibaba IPO back in the day, 04, 05, 06, it wasn't just about, Jack Ma explaining what Alibaba was, because their business model of digitizing factories, putting a profile up and charging $10 a month for a little gold star to say that that factory was certified as a real factory. And that's not like a great model, but it was a great model for them. But Jack Ma, the key for him is that he was not just selling Alibaba, he was selling China to an investor base. So what we really need to work out collectively, all of us, is to drive a education of the market into what the opportunity is. Because the numbers on a geopolitical, it's like 7% growth in emerging markets, and it's more than half of the world's economy. But it's an education to get investors really excited about what that opportunity is. So there's a few things that are very important there. It's transparency, it's reporting, and it's profitability. You cannot argue with net income. And so investors around the world, they don't invest in dots, they invest in lines. So if you can create that line and it's focused on really making money, we can actually get exits. And so what we are focused on, we're early stage, but we do have 250 portfolio companies. And the key thing about our portfolio companies is that they are all either break even or they can grow break even anytime. And they're like scaling up and from very small base. But for Pakistan, what we're looking at is a bunch of profitable companies that will hopefully get there. So I think that there is this opportunity to like flip the game and to like pull China on the world, educate the market, the global markets, not just on the companies, but also on the markets. And with that, we can get exits. And we've seen it happen before, like Southeast Asia. They weren't there. Now they're there. India was not there. When I invested in India in 2005, that wasn't there. It'll be there. But what we can do for the emerging markets around the world, I think that we can get the word out and help with that transparency and that, I don't know, call it PR, but I prefer to call it education. And we will get from here to here to here. And thanks for letting me talk so much. Yeah, I'm very thankful to the other guy not showing up.
Thank you to both of you for helping me utilize the time to the maximum and stepping in for the gentleman who was unable to make it. We have 9 minutes left. Thank you for the insights. I think both of you were very comprehensive in your answers, and clearly they come from experience and kind of being hands-on with your portfolio companies. I'm going to randomly pick 3 questions. The topic wasn't Pakistan, and there's a lot of Pakistan-specific questions, so I'm going to just pick one Pakistan-focused question. So let's see. The first one is... Okay, let's do this one. It's more generic, but I guess it's for all the founders on the call that just want a little bit more visibility about both your firms. So what is the typical ticket size or check size for both Orbit and BII? And what type of companies or sector-specific focus do you have, if at all? Either of you can go first.
Go Sonal, because yeah.
So BII is quite a large institution, and so we don't really have a typical check size, but that's largely because we invest in everything from kind of your early stage startups to sort of large infrastructure projects. I will say, like, maybe in the early stage space, our ticket sizes, I'd say we'd focus more on Series A and upwards. We don't tend to do seed and sort of even pre-Series A in some markets just because of the sort of risk return, and also The fact that we also do investments via intermediaries, so our GPs who kind of do this sort of local seed and sort of pre-seed investing for us. At Series A stage, I'd say our ticket size probably starts at about $5 million and then obviously can scale upwards as the company grows.
Yeah, so my goal in life is to have Sonal actually invest in our fund. So we are in that like pre-seed seed. We invest early. We invest 180K. We take a very, very traditional, when I say traditional, like 18 years ago, traditional model. So we invest 180K or 100 to 180K. We keep a little bit of it in program fee, and we take some common stock for our lifetime support program. So the idea here is that we don't want our founders that we back to make the Jack Ma mistake. So Jack Ma and his team took 95% dilution before they exited, and he's a lucky one. I mean, he still made a lot of money, but he took 94% dilution before he exited. So we do invest money, and but on the other side, we take a small ownership target to get to a total of like 5, 6, 7, 8%, sometimes 9% total ownership. And then we work through our lifetime program to help the companies get to where they want to go, which is the key thing is positive unit economics and a place where they're like break even-ish or can go break even anytime. And then it's a lifetime support program. So I think if you like read blogs about like US VCs, you're getting the wrong idea. Okay. So there's this thing called power law, which is like we invest in 10 companies and we make money on one. Okay, or the good ones do 30 companies and they make money on 5. So our focus is we work with many companies, usually like 30 to 40 a year, and it's a lifetime support program. So we invest and we're helping them build a real business because we're coming in and we get this common stock. Our economic model is we're coming in quite early. And the idea is not to just have the power law, not just to have the 1 in 10. Because like if you spray and pray, if like you do 10 investments and you're throwing a dart at a board, you're going to get one, right? And there's always going to be the ones that don't work out. The craziest thing I ever happened is one of the co-founders bit the other co-founder in the leg and it didn't work out, right? They just couldn't work together anymore. Funny one because it's evening for me. But think about it like this. So we invest and then we, through our support, try and push up the middle. So for us, when we first started off, we're not making money on 1 in 10. We're making money on 1 in 2.5. And then we got better. Our 2019 fund, that was 15. Our 2019 fund, we're making money on 1 in 4.4. And now, since 2021, in this crappy market where there's not people investing in Pakistan or Bangladesh or Africa, the VCs basically froze up. We had 80 companies go through our fundraising module. They went through our investor week and our demo day. There's only like 5 dead. Because what we're here to do is help people build businesses. And because we're coming in at an early stage, we have this unfair advantage where we're not chasing unicorns. We're not chasing, like decacorns. We're basically helping people build a real business. And the cool thing about what we do, and we're kind of changing the model, is we're enabling the founders that we work with to work with each other, to support each other. And that's that old kind of like accelerator model. But for us, it's lifetime. So that's a pitch for us. So Sonal, I'm looking forward to that check.
Thanks very much. I'm going to ask the last question and just merge the last two with the Pakistan focus. How do you think about acceptable versus unacceptable risk within companies that you look to invest in? And then the second question, which you can just touch upon high level, is what are your projections or predictions for VC investments in 2025, especially with respect to Pakistan?
You want me to go and you can think about it? Okay, so it's all about trust. So we are investing in founders, not businesses. We're early stage. And so we look at 2 things, the people, and then we look at the problem that they're super passionate about solving the product will always get there, or it'll change. The business model doesn't really matter. It's about the people and the passion to solve the problem. We actually don't invest in that many like super young people, but sometimes we do. But we invest in people who are a little bit angry, slightly angry, pissed off a bit about wanting to solve a problem within their local market. So the funny thing about us is we invest in local founders in the markets, and then they understand what's going on in the local markets. And what we're bringing in is like that experience from other markets, but not to tell them what to do. As I said before, it's to design the experiments, and then we help them get to kind of like where we're going, where they want to go. So I would say like the most important thing for both Pakistan founders and founders around the world doesn't really matter like where you're coming from. Or the funniest thing is like we don't actually background check. I mean, we background check for criminality, but we don't actually spend a lot of time looking at where somebody went to school. And it turns out for all the founders that we backed in Pakistan, none of them really went to posh schools around the world. Actually, zero of them. We had one guy who got a master's from a school in London, but it was in like Islamic studies. It had nothing to do with food delivery software. And we're talking about Blink. It used to be called Eat Mubarak, but Blink, Cyrus, an amazing guy. What we're looking for is that passion, and also that hunger, and also that local understanding of what does it take to actually drive the transformation. Because for as investors, we're not local anywhere. But what we can bring is the tools and some of the insights to allow them to make the decision through that experimental the phase. And so the reason why we are top 5, 10% performing VC in the world is because our founders are successful, not just 1 in 10, but like 3, 4, 5, and 6 out of 10. So anyway, reach out and look forward to working with you all.
Thank you.
Yeah,
Sonal?
maybe I'll just add to that. So I think in terms of unacceptable risks, basically, what William was saying, the only other thing I'd add is that obviously as a DFI, ESG and business integrity risks are things that we will not take. So businesses have to be built right from the start, and founder values and sort of the foundation is super important to us. In terms of, I mean, I'm not going to make any predictions for Pakistan. I don't even buy into my own predictions, but things I would like to see. I would like to see sort of more fintech models, businesses working with banks. There's a very well-established banking system, but I think, startups helping these banks get credit to the right places is something that, we'd like to see more of. On the ag tech side as well, I mean, Pakistan has a lot of agriculture is a major value driver for the economy. So I think it would be good to see more ag tech solutions coming out of Pakistan as well. So, I mean, those are two sectors that we'd like to see more of, and hopefully in 2025.
Yeah, if there's any bankers or sellers of fertilizer seed in the audience, please partner with us because it's tough. It's tough. Yeah, you're like U.S. healthcare or U.S. telcos. Very difficult to move.
Awesome. Well, thank you both of you for the time, the energy, and the insights. Really appreciate everything you've had to share. Thank you to the audience for participating and listening in. We hope there was some learning in this for you. And to William's point, if any of you out there want to reach out to engage, to share your decks, you're an early stage founder, looking for funding, want to learn more, I guess both of our speakers are more than willing and able to be open to your inbound. Thanks again, everyone, and wishing you a pleasant evening.
Hey, Ali, thank you so much for moderating. Thank you. And Sonal, very nice to connect.
Me too. Hi.
Thank you. Take care.